Hi, this is Rob Carrig with Carrig Wealth Advisors. Today is Friday, June 23rd, 2023. I'm going to take about 2 minutes today and walk through one slide that I think explains a lot of what has happened the last year or so and also informs some of our decisions going forward. We're going to talk about what has happened the last couple of years, and most importantly, I'm going to tell you a mistake that I think a lot of investors are making right now in this environment. Okay. As you can see on this chart here, this is the Fed and interest rates. So the black line here is the Fed funds rate set by the Federal Reserve. When you hear that the Fed is raising interest rates, this is what they're talking about here. So you can see, main point I want to make here is interest rates right now, which is the Fed funds rate, but also heavily impacts what you can get on treasuries and CDs and money markets and things like that, has not been this high since 2006 or 7 or so. The source of all of this is right here: Bloomberg, FactSet, Federal Reserve, JP Morgan Asset Management. So point number one is that many people are taking advantage of this high interest rate environment and locking in yields in the 5% range, depending on how long you go out, in things like CDs and treasuries. And as you can see, it's been a good 15 years since investors have been able to do that. That's point number one. Point number two is when people wonder why the return on bonds and bond funds was so bad last year, CNBC says it was the worst returns of all time. It's right here. This is the reason. When interest rates go up, the price of existing bonds go down. That happened about 15, 20 years ago, but happened in a much more gradual fashion. This happened very quickly. So last year was, by most accounts, the worst year ever for bonds and bond funds, says CNBC. That's point number two. Point number three, what many people are doing right now is hiding out in money market accounts with daily liquidity. Bloomberg says that there's $5.2 trillion right now in money market accounts. Most of those funds, we offer many of them, are yielding over 5% on a taxable basis. Though that may be attractive and feel good, as you can see here with the green and the blue, many people expect that interest rates will start to go down at some point, maybe 6 months from now. Money market accounts do not lock in any sort of yield. Whereas if you buy a CD or a treasury, you're locking in some sort of yield. We had an investor yesterday that we met with where we bought CDs that mature in 3, 4, and 5 years that pay 4.7, 4.55, and 4.5% respectively. So you'll notice the further you go out, the less that investor is making in a guaranteed return. Why would you do that? Well, you would do that if you were afraid that the 1 month CD or the 1 year CD, when that matures, rates are going to be considerably lower. So we're locking in that yield for a longer period of time. I think a mistake a lot of investors are making in money market accounts or buying 1 year treasuries is loving this 5% yield, but it's not going to be there that long because it's only locked in for, a month or maybe even not at all. Anyway, that's it. I want to keep it brief. If I can be of any assistance, feel free to get in touch, rob.carrig@stewardpartners.com or 603-427-8840. Thank you and have a great summer.